Welcome to InvestorHubX.com. Most traders think the market is random, but when you study price closely, you start to notice something very interesting. The same structure appears again and again, whether you zoom in or zoom out. This concept is known as fractal market structure. And in today's lesson, we're going to break it down using Bitcoin as a real example. In this video, we'll cover an example of fractal market structure using the Bitcoin chart in 2021. The three key market phases. What makes market structure fractal? Why fractals are actually repeating behavior? And how traders can use this pattern in real trading. Let's get started. This is the Bitcoin chart in 2021 on the daily time frame. Price had a huge run-up, making higher highs and higher lows. There was strong momentum, and everyone became bullish. But notice something interesting. Each push higher becomes weaker and weaker. Momentum starts to slow down. The chart becomes choppy and begins to move sideways. You'll start to see fake breakouts, sudden drops, followed by quick recoveries. This is where most traders get confused, and then eventually, price breaks down. The structure shifts from higher highs and higher lows into lower highs and lower lows. And this is where late buyers get trapped, right after chasing the market at the top. This entire structure is what we call fractal market structure. The fractal market structure can be divided into three phases. The first phase is markup. Price starts trending upward. We see higher highs and higher lows. Buyers are in control, momentum builds, confidence increases, and as price rises, more people become bullish. Early buyers are already in profit, while late buyers start chasing the move. Next, we move into phase 2, the distribution phase. Instead of trending higher, price starts moving sideways. The market becomes choppy and uncertain. You'll see fake breakouts, sudden drops, and quick recoveries. This is where traders get confused, because the market still looks strong. But in reality, smart money is selling, while retail is still buying. Finally, we enter phase 3, the markdown phase. Price breaks down, and the structure changes from higher highs and higher lows to lower highs and lower lows. The trend has reversed. Sellers are now in control. This is where panic selling begins, and late buyers get trapped. Fear takes over the market. So when you combine all three phases, you get a complete market cycle. Markup, distribution, and markdown. And once you learn to recognize these phases, the market starts to make a lot more sense. So, what makes market structure fractal? What makes it fractal is actually very simple. The same structure repeats itself at different scales. A big trend contains smaller trends. A big range contains smaller ranges. And a big breakdown contains smaller breakdowns. The pattern is different in size, but similar in behavior. That is what makes the market fractal. Now, let's go back to the Bitcoin chart in 2021 on the daily time frame. This is the fractal we saw earlier. But if we zoom into the 4-hour chart, do you notice something interesting? You start to see the same structure forming again. Smaller trends, smaller ranges, and smaller breakdowns, all happening inside the bigger move. So when we say market structure is fractal, we mean that the market repeats the same story at every level and on every time frame. So you may wonder, why are fractals repeating behavior? Fractals repeat because human behavior repeats. When price rises, people become confident and greedy. When momentum slows, confusion begins. And when price drops, Fear and panic take over. These emotions don't change, so the same market structure keeps repeating. Unlike other chart patterns, fractals don't describe shapes, they describe behavior. Patterns like double tops or wedges are just specific formations. But fractals are different. They represent the entire structure of the market. And since human behavior repeats at every level, that structure naturally repeats at every scale. That is why the market is fractal. So, how can traders actually use fractals in real trading? First, use fractals to identify the current market phase. Is the market trending up, moving sideways, or breaking down? Second, trade with the structure, not against it. In an uptrend, look for buying opportunities. In a downtrend, look for selling opportunities. Third, use smaller fractals for entry. Once you identify the big trend on a higher time frame, zoom into a lower time frame and look for smaller fractal structures to enter your trade. For example, a big uptrend on the daily chart may contain smaller pullbacks on the 1-hour chart. Those pullbacks can be your entry. Remember, fractals don't predict the market. They help you understand structure. And once you understand structure, you can react with better timing. To summarize, we've learned about fractal market structure. We covered the 3 key market phases: markup, distribution, and markdown. We explored what makes market structure fractal and why fractals are actually repeating behavior driven by human psychology. And most importantly, we looked at how traders can use this concept in real trading to understand structure, improve timing, and trade with the market. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.